Okay, let's try to pull all of this together now and look at an actual investment decision. We'll look at a few assumptions. Let's lay out a few assumptions here. First, the $50,000 piece of equipment is going to be depreciated over a 5-year period. So $50,000 appreciation analysis allows purchase of machinery with a 6-year productive life, and that is covered by 5-year MACRs. The project is going to produce an income of $18,500 a year for the first 3 years, and that's before depreciation and taxes. And in the last 3 years, the income declines to $12,000 before depreciation and taxes. Our corporate tax rate is 35%, and the cost of capital is 10%. We'll step through quickly what we're going to do on a year-by-year basis, but I think it'll be easier here in a moment when we actually see the numbers. In every year, we're going to take the depreciation, we're going to subtract that from earnings before depreciation and taxes, and that will allow us to arrive at an earnings before taxes number. The taxes are then computed. We subtract the taxes, that's a real cash flow. That gives us earnings after tax, and then we're going to add back the depreciation to arrive at the cash flow from this project. After we do that, we'll apply net present value analysis. So the depreciation schedule, we've got 5-year MACRs. You've already seen this earlier. The $50,000 each year, the percentages in column 3, and the annual depreciation deductions that we're going to use are all here in column 4. So we're going to use those, and the first year depreciation is $10,000. Let's look at the cash flows. All right, we're going to build the cash flows. We'll look at 1 year only. We'll look at year 1, then we can we do the same thing in every year, basically. In year 1, under our assumptions, we had earnings before depreciation and taxes of $18,500. And we just saw on the previous slide that the depreciation for that $50,000 piece of machinery in the first year is $10,000. So we're going to deduct $10,000. We now have earnings before taxes. Okay. The earnings before taxes, we multiply by 35%. We find the tax rate of, or the tax amount of $2,975, which we deduct for earnings before taxes to get earnings after taxes. So earnings after tax is now $5,225, and then we add back depreciation. Okay, this is the important point. Made it before, but it's so critically important. I want to make it again. We've deducted depreciation here. We add back the exact same depreciation there. Why do we do that? Well, there's only one thing that we've done in between, and that is we've calculated the tax amount. So in order to get the tax amount right, we have to, the government allows us to deduct depreciation for tax purposes. Taxes are a real cash flow. So in order to get the tax number right, we have to deduct the depreciation, but we have to add back the depreciation because depreciation itself is not a cash flow. So after we've deducted it and added it back, the depreciation is not in there, but the effect of the depreciation on taxes is. After adding back the depreciation, the cash flow in the first year is $15,525. The next 5 years, we do exactly the same thing. The only thing that's changing is the amount of the depreciation in each year changes in accordance with the depreciation schedule. But in each case, we add that depreciation back after we calculate the taxes. So along the bottom here in red, we have all of the cash flows for each of the years on the basis of the assumptions that we've made. The final step, now that we know the cash flows, we have to do our net present value analysis. The bottom row in the previous slide is now this column, the cash flows. Those numbers are exactly the same. And we're now just going to find the present value for every one of those cash flows. So the first year's cash flow of $15,225 multiplied by the present value interest factor gives us a present value of that amount of $14,112. We do that for every year. We add them all up, and then we have a total cash inflows, the present value of the cash inflows. We subtract from that the $50,000 cost of the equipment, and we're left with a net present value of $7,991. It's positive. It's got a positive NPV, and therefore, on the basis of these cash flow projections, we should undertake this particular project.